Basic Lecture Number 2, Trends. The main subject of this tape will be trends. What trends are, what causes them, how to identify and analyze them, and how to use them in speculative operations. Let us define a trend first. A trend is to have or to take a particular direction. It is the underlying or prevailing tendency of inclination of movement. In other words, a trend is a tendency to move in a particular direction. Trends are governed by the law of supply and demand. For a brief review, the law of supply and demand says that when demand is stronger than supply, prices will rise. When supply is stronger than demand, prices will decline. When demand and supply are in equilibrium, the price will move sideways or will be unchanged. This sideways trend is called a trading range. Supply and demand must be judged by what happens to the price, the number of shares bought and sold, volume, and how long it takes to complete the movement, time. In other words, price, volume, and time. Our purpose is to diagnose the direction and strength of the coming trend and to take a position in harmony with it. We aim to take that position as the trend is beginning to be established, or after a reaction within the trend has occurred, to take a position as the trend is resuming its movement. Caution: do not buck trends. Price changes and trends which result from these price changes are caused by an unbalanced condition of the flow of orders coming into the market. Please turn to chart number 1 for a very simple illustration. Suppose an order for 2,000 shares comes into the market to buy a stock. The stock is selling for $50 per share, and there are only 300 shares to be sold at that price. The specialist could fill this order for 300 shares and then raise the bid price until the entire order is filled. We will assume that there are no additional buying and selling orders coming in as this particular order is executed. So, 300 shares are sold at 50, another 100 shares at 50 and an eighth, 200 at 50 and a quarter, 100 shares at 50 and 3/8, 500 at 50 and a half, 200 at 50 and 5/8, and these orders to sell have all been filled. At this point, the specialist still has 600 shares to be bought. There are 100 shares at 50 and 3/4, and then at 50 and 7/8, the remaining 500 shares are bought. Thus, the price has moved up 7/8 of a point in executing the order. This is extremely simplified. In the actual market, as this order would be executed, additional orders would come into the market on both the buying and selling side to be matched and executed. The price would move back and forth, depending upon whether there were more shares to be bought or to be sold at any particular moment. These trends may be portrayed in tabular form or in chart form. They may be most readily analyzed when they're in chart form. We use 3 types of charts primarily: a vertical line chart, a figure chart, and a wave chart. And in these lectures, we will discuss all 3. Most people think there are only 2 trends. However, there are 3 types of trends classified as to direction of movement. There is an upward trend, a downward trend, and a sideways trend, or trading range. There are many ways to classify trends as to types or the size of trends. Elaborate systems have been worked out to classify trends. Do not do this. It leads to extreme confusion and very often to financial disaster. At Stock Market Institute, we use 4 classifications for simplicity: the intraday, the minor, the intermediate, and the major trends. This is not a precise or mathematically absolute classification, and we are not interested primarily in what you call a trend, but we are extremely interested in your understanding of it. What is extremely important is your understanding of the supply and demand relationships as the trend develops. The intraday trends are caused by very small fluctuations, those fluctuations occurring within a day, and there may be several of these within one day. Intraday trends are usually a day or 2 in duration. Essentially, a person must have an intraday breakdown to analyze these intraday trends, and it really requires a tape reader's operating setup and technique. Intraday trends on the Wyckoff wave are published on our daily stock report. Minor trends are made up usually of 3 or more intraday trends, and are moves of up to approximately 10% of the price of the stock. Usually they last for a couple of days to a couple of weeks. The intermediate trends, which are made up of 3 or more minor trends and are movements of around 15 to 20% of the stock. They usually run for a couple of weeks to a couple of months. A major trend is made up of 3 or more intermediate trends and is a movement of over 25% of the price of the stock. Usually major trends will last for several months or perhaps much longer. We wish to emphasize that you should not make a precise or exact mathematical or absolute classification of strict percentages. There is a gray area between intraday to minor, the minor to intermediate, intermediate to major. The important thing is not how you classify the trend, but your judgment as to the strength of supply compared to the strength of demand. To show you how these trends persist and persist and persist, on the Wyckoff wave there was a major support trend line drawn through the low of September 1953 and the low of 1957. This support line was met on the low of the 1960 down market, and the wave turned upward. This support line was finally broken on the 1962 decline. We have found that very often we can illustrate principles best by drawing a freehand chart or a schematic diagram to illustrate the general principles, followed by a discussion of actual examples showing some classic situations and some variations. To begin this study, please turn to chart number 2. On this chart we have a study of supply and demand. The Wyckoff course teaches the student must first learn and understand the motives, behavior patterns, and the emotions of the people who go to make up the market. For instance, it is normal for people to go to extremes. In an advancing market, it is normal for greed to overcome reason, resulting in a demand which pushes the stock up into an overbought position. Likewise, in a declining market, it is easy for fear to cause selling, which may result in lower prices, causing more fear and supply, which drives the price down, down, down into an oversold position. These market fluctuations are caused primarily by fear and greed. Let's take time out to discuss this for a moment. This is a good use of fear and greed. Actually, everything that you and I and everyone else does is to some degree based upon the simple use of the emotions of fear and greed. At first they sound like nasty words because they are very often used in a very non-complimentary way. We mean them in a very delicate and positive way. There's nothing wrong about being greedy as long as it is not carried to extremes. The reason you are studying your Wyckoff course is because you want to get ahead. You want to make money or protect your capital. Furthermore, almost all of us carry life insurance because we are fearful. We are fearful something will happen. This is a very simple use of a very important emotion. Now, everything that you and I do is based upon some use of these two emotions. We may rationalize and attempt to base our analysis and actions on reason, but this fear and greed are still there to some extent. The trouble is, in the stock market, fear and greed are carried to extremes. Let's see what happens as the market begins to go down and panic selling comes in. This is usually precipitated by bad news. Usually this fear selling will snowball until it is finally stopped by superior demand coming in on a selling climax. Gradually, this fear runs itself out. It goes to too much of an extreme. Similarly, the buying based on greed grows and grows on an upward move until it is finally stopped by a buying climax. As the market moves up, too much greed comes in. This process creates what we call the oversold and overbought positions or situations. In the oversold area, the stock or the market can go through accumulation, and in the overbought area, it goes through distribution. Let's return to chart number 2. Here we portray the market in a general upward slanting trend. We call it the primary growth trend. Sometimes it is a downward slanting trend. This is the general direction or rate of growth that the market, an index, a stock, or you might say the economy or company is taking. Now, market prices, or the price line, fluctuates widely above and below this growth trend line. If we draw a line through the center of the general price pattern as it moves up and down, we get somewhat of a curved line or cycle. It goes way down below the primary growth trend line and then fluctuates well above it and then back and forth. Again, generally the stock will go through accumulation in the oversold area and distribution in the overbought area. Now please turn to chart number 3. We can break down this cycle or wave-like pattern into 4 phases: accumulation, markup, distribution, and markdown. We are interested primarily in what is happening to supply and demand. In the accumulation area, demand is coming in to gradually overcome and absorb the supply, and to support the stock at this level. In the markup area, demand is greater than supply. In the distribution area, supply overcomes the demand, stops the upward move, and eventually begins the downward move. In the markdown phase, supply is greater than demand. We can also look at this in another way. Mr. Wyckoff says that each stock or each move goes through a period of preparation before the execution of the move. This would correspond to the accumulation and markup phases. The other preparation and execution phase being distribution and markdown. In chart number 3, we have shown the oversold position as an area where the intelligent and knowledgeable investor or speculator accumulates stock. The overbought position is the area where he will distribute or sell his stock. This pattern holds true whether his speculative objectives are short-term, intermediate, or long-term. In chart number 4, we have portrayed a series of minor fluctuation or intraday waves. These build up and build down and form minor moves or minor trends. Actually, every upward or downward swing in the market, whether it amounts to many points, only a few points, or fractions of a point, consists of numerous buying and selling waves. These have a certain duration. They run just so long as they can attract a following. When this following is exhausted for the time being, that wave comes to an end, and a contrary wave sets in. The small buying and selling waves which occur during every stock market session run so many minutes. These small waves are a part of the larger waves which run so many days and eventually make up movements which we call short-term rallies and reactions or minor moves. Our illustration shows this up and down price action, which reflects the buying and selling waves caused by the shifting relationship of supply to demand. In chart number 4, from A to B, we have a series of intraday moves of generally equal strength, and in general the up moves are about the same strength as the down waves. Thus the stock moves sideways in a narrow trading range, a very small trading range. However, from B to C we have a minor up move composed of several intraday trends, in which the rallies are stronger than the reactions. Demand on the rallies is stronger than the supply which comes in on the reactions, and thus we have an upward minor trend. In chart number 5, we have shown how these build up and build down into intermediate advances and declines. All stock movements, however large or small, are made up of buying and selling waves. A stock moves to a higher or lower level by a series of surges, a good deal like an incoming tide with successive waves higher or lower than those preceding. As shown in chart 5, the short-term rallies and reactions, the minor moves, build into intermediate advances and declines. By studying the relationship between these upward and downward waves, their duration, speed, and extent, and comparing them to each other, we are able to estimate and judge the relative strength of the bears and the bulls, or better yet, the supply and demand as the price movement progresses. In chart 6, we have a series of intermediate trends which form the long-term or major trends, or to express it another way, the long-term bull and bear markets. From A to B, we have an upward trend, a major upward trend which is composed of a number of intermediate trends in which the uptrends are stronger than the reactions. Demand is stronger than supply. You will be able to judge the supply and demand on the basis of the price action, volume, and time. There is a widened spread and an increasing volume on the rallies. On the reaction, there will be decreased volume and a comparatively narrow spread compared to the rally, indicating less selling on the reaction than there was buying on the upside. In an uptrend, you should not have prolonged price weakness or massive dumping of stocks on the reactions. Continuing with chart number 6, from B to C, we have a downward trend composed of a number of intermediate trends, indicating the good supply on the downside and a lack of demand on the rallies. Again, you will be able to judge this on the basis of the price action, the time, and the volume. Volume should remain good on the downside. The rallies, however, should be relatively weak, indicating a lack of demand. There should not be widespread or increased volume or sustained increased volume, and it may take quite a bit of time on the rallies. The main point is that you have an unbalanced condition in the supply and demand, with supply good on the downside and a lack of demand, weak demand, on the rally. Let's spend a little time with chart number 6 and discuss some variations. Very often, these stocks will go through a period of reaccumulation, building a complete new count, such as is illustrated from E to D. Sometimes, instead of going through a complete new count building process, the stock will simply come down, dry up the supply, and again resume the upward trend after having made an intermediate correction. We have portrayed this at F. Often it will go through minor or intermediate distribution in the major upward trends, precipitating and causing these corrections. The same thing can occur in the down market with a rally, in which a stock will build a complete new stepping stone count for the downside. Or it may simply rally, run out of demand, and then resume the downtrend. This, in brief, is the basic idea behind trends, how they are formed, and what causes them. Now let's go into some practical applications, including how you can measure the trends and how you can trade a stock that has already begun this upward or downward trend. Please turn to chart number 7. Chart number 7 is a study of two important trends in the Wyckoff Wave Index beginning in August 1968. The first important trend is from number 1 to number 2. The second is a downtrend from number 2 to number 3. The first is an intermediate trend, made up of several smaller or minor moves. The first minor move is from 1 to 4, a reaction from 4 to 5, and then a long move from 5 to 2, with some very small reactions such as 6 to 7. On an uptrend, there should be good demand on rallies, followed by a falling off or decreasing volume, and a narrowing spread on reactions compared to the prior rally. The Wednesday's closing on the New York Stock Exchange during the latter half of 1968 caused some distortion in the normal volume pattern. This usually caused exceptionally high volume on Thursday. At SMI, we use three methods of measuring trends: trend lines, thrusts, and halfway points. We measure the angle at which the trend is moving through the use of trend lines. Trend lines form a channel of movement similar to a frame for a picture. There are two types of trend lines: the normal use and the reverse use. We also measure the amount of progress that is made on each drive up and drive down. This is called the thrust. The third measurement is the halfway point, which is an indication of comparative strength and weakness and the adequacy of the correction. When placing the trend lines, the thrust, and the halfway point on your chart, you should do it with a great deal of exactness. However, do not expect the stock or the index to observe or reach them perfectly. For instance, on a reaction within an upward trend, do not expect the stock to come down to the exact trend line and turn upward. It may penetrate a little bit, or it may hold slightly above the support line or the trend line. The important thing is how it reacts, not the exact point to which it reacts. To break a support line on light or decreasing volume means relatively little, and often enables the stock to resume the uptrend within the same primary trend lines. To break the support lines on increased or high volume and good price spread is a different matter. It indicates a change in the supply-demand relationship, and usually results in the stock establishing a new trend, perhaps a new trend in the same upward direction. Another way to analyze the breaking of a supply line is to study the possibility it is creating an overbought condition. It may result in a steeper angle of trend. To summarize, The breaking of a trend line may result in establishing a slower or faster trend in the same direction or in a complete new trend. The supply-demand relationship will determine the continuing trend. It can change rapidly, so our advice is to watch it closely. We usually identify trend lines with letters such as AA, BB, CC, etc. It may be helpful for you to follow this practice, and it will help us in our correspondence with you if we all use the same system of letters and numbers. At SMI, we use two types of trend lines, the normal use and the reverse use. In the normal use of trend lines in an upward trend, we draw the support line first, with the supply line drawn second, parallel to the support line. How do we draw these trend lines? First, locate two consecutive lines of support on a reaction and draw the support lines through those points. Examples of these are on Chart 7, line AA, which was drawn through points 1 and 5, and Chart 9, line AA, drawn through points 1 and 3. Now the supply line is drawn parallel to these support lines, drawn through the top of the rally which occurs between the two support points. On Chart 7, line BB is the supply line drawn parallel to AA through 4. In a downtrend, again using the normal use of trend lines, the supply line is drawn first through two important supply points. An example of this is line EE on Chart 9, which is drawn through 2 and 20, with the support line FF drawn parallel to it through 21. With the reverse use of trend lines in an upward trend, we draw the supply line first, followed by a support line drawn second and parallel to it. An example of this is on Chart 9. Line CC is the supply line drawn through points 7 and 8, with the support line DD drawn second through 11. In a downtrend using the reverse use of trend lines, the support line is drawn first through two support points and the supply line drawn parallel to it through the top of the rally occurring between those points. An example is line CC on Chart 8, drawn through points 4 and 5, with the supply line DD drawn parallel to it through point 7. We have never seen the reverse use of trend lines used except by SMI. You should soon discover their unique value in your technical analysis of individual stocks and of the market. On Chart 7, we're going to use the normal use of trend lines only. Line AA is the support line drawn through numbers 1 and 5. The wave meets support several times near AA on small reactions, then meets it at number 7 and turns up. At number 8, it breaks through AA with widespread and increased volume, indicating that AA is no longer operative. These shorter and temporary lines within the more important trend lines often are very helpful in alerting one to coming change in trend, a change of character, or a decisive shift in supply or demand. They may be erased later when no longer needed. The supply line BB is drawn through number 4 parallel to AA, and eventually it is met at number 2, and the Wyckoff wave turns downward. We could also draw another supply line CC parallel to AA through point number 9, when it failed to reach line BB at number 12. This would show the failure to reach the line BB where it could or perhaps should have reached. Slowly study the price action and volume beginning with point number 1 over past point number 8. Do you see the expansion of the price spread and the increasing volume on each rally? This is evidence of good demand. Then, note the lack of supply on the reactions. The volume shrinks on the reactions at 5, 9, 10, 11, and 7. However, at number 8, there was a decisive change in character as supply was heavy, as shown by the wide spread, and increased heavy volume on the downside. Now let's draw the thrust. The thrust measures the price progress that the stock or index makes on each wave within the trend. The thrust is the price difference between consecutive tops in uptrends or between consecutive bottoms in downtrends. To measure the thrust, we draw a series of horizontal lines at the level the highs and lows are reached on the drive within the trend. and connect them with a vertical line. For example, we have drawn the thrust A', B', and C' to measure the net progress of each subsequent drive up on the move from 1 to 2. A' measures the amount of progress made from 1 to 4. B' measures the progress from 4 to 6. There is a sizable reaction, and a more prolonged reaction from 6 down to 7. And then C' measures the progress from 6 up to 2. Note the shortening of the thrust, the lack of progress made on a move. This is an indication that you should examine the market action very carefully to determine what is happening to that trend. It may be running out of the underlying push caused by demand overcoming supply, or opposition may be coming in to stop the advance, or supply overcoming demand. There will be times when you will be in doubt as to whether you should draw the thrust through a certain point. This is a matter of individual judgment. The judgment will largely depend on the depth of the correction within the trend. The time spent in the correction, your